out of many trades in the pandemic as well. And I take them very seriously because they usually lead to very good signals.
Before we move forward, I'd just like to remind you that we're giving away $100 to a random subscriber at the end of this month. To take part in it, all you have to do is subscribe to our channel, like this video, and leave a comment in the comments section below. Good luck. Now coming back to Raoul Pal's interview, he talked about several current trends in the market, inflation, and what could propel Bitcoin to new highs in the coming months. He talked about the latest upgrades for Bitcoin and how they've affected Bitcoin and will continue to do so in the near future. But then he also issued a warning about what he thinks could bring a new wave of sell-offs for Bitcoin over the next few months. If you want to hear Raoul's comments on the crypto market, watch this video till the end and don't forget to press the like button. Now, let's look at his interview.
How does it play out for stuff like crypto? Well, the crypto story is still amazing, right? The crypto story is still a technological adoption curve. It's still Metcalfe's law. It's a slow year for adoption. But adoption's actually been sideways. People haven't left the crypto ecosystem like they did in 2018, which is why we've had a much more of a sloppy sideways range. And I think that adoption continues. And if it continues this way, by the time we get to 2030, we end up with 5 billion people or 4 billion people using crypto. This chart's actually been updated since, and we found that the rate of adoption was even faster. Last year, we had about 186% rate of adoption. You can see what that's like compared to the internet. Overall, it's about twice the speed of internet adoption, and that's truly extraordinary. And it tells us that going forwards, even though the internet, as it becomes a more adopted network, the rate of growth comes down, but the numbers become huge. And that's what's important to the valuation of the market cap of crypto. So again, if we look at these updated numbers, even if we assume some slowdown, whether it slows down by the same percentage change that the internet did after year 6, starting at 5 million users, took year 6 after that, it started slowing down to 43%. If we adjusted by the same amount, we get to 76% growth in crypto. We still get to 2.8 billion users in the next 4 years. If we slow it down to match that of the internet, we get 1.2 billion users. And the internet at that stage was at 500 million. So you can see the dramatic increase. And this is what increases the value of crypto. This is Metcalfe's law. This is network adoption. And what we're also finding is technology, each one at a time, comes at a faster speed. So Bitcoin's adoption was extremely rapid. Ethereum has been much more rapid. And I think some of the other layer ones like Solana have been even more rapid than Bitcoin. And I expect that to continue because the base layer was there. Bitcoin was adopted so fast because the internet existed. Ethereum was adopted so fast because Bitcoin had existed and had been adopted. And the same with the other layer ones. Same with NFTs, which were even faster in adoption. If we think of the value accretion to the Bored Ape Yacht Club, for example, it's probably the fastest value accretion to any asset in all history. It's about 250,000% in a year, which is truly extraordinary. So that's kind of what's going on. And if network adoption models are the key models, I've spent a long time looking at this because a lot of people still don't really understand it. And I thought, how can I model this in a way that makes sense to an idiot like me? Because Metcalfe's law is a complicated formula where we don't have the simple inputs so we can just put it into a model. So I went through all of the different things on chain and the various factors and found that I could best describe the price action of Bitcoin via looking at the total transaction volumes in dollar terms versus the number of active addresses. And that makes total sense. A network of 2 people transacting $1 billion a week is nice, but it's not a network. But the same $1 billion a week transacted by 1 billion people is incredibly valuable. So Bitcoin transacts more volumes than anything else, and it has a lot of active addresses. And what's amazing is the 2 charts, even though the numbers are wildly different, the 2 charts mirror each other perfectly. It tells you that price is actually a great indicator of network adoption. So it doesn't give you a lead, and I'm working on rate of change models and other things to give us some leads on this. But generally it tells you cryptos are generally well priced. by the market. It's very efficient in what it does. Now, don't forget, price is not an input in the model, and it works for every single crypto asset I've ever looked at. So here's Ethereum. Works perfectly too, exactly the same. And it works for, I've seen it in all sorts of things from Polkadot through to XRP. People don't want to believe that. They want to believe that crypto is all about network adoption models that are unique to that particular crypto. No, it's the narrative that builds the network and the utility of the network, but they're all priced in the same way. So net, how does this all come together? It all comes together in what I think is a dramatic risk off that happens over the next 4 to 5 weeks. Much like the end of 2018. Those of you from the crypto markets will remember Bitcoin fell 50% over that period and put in the low. I think we're starting to see that kind of scary price action. The equity market as of today has put in a DMARC indicator daily low, but this is around the month-end rebalance effects, and we know the month-end rebalance is going to be one of the largest ever, meaning pension funds to rebalance their portfolios have to buy a lot of equities. They're doing that. They probably need to get it done before the long weekend in the United States. After that, I think crypto is telling us it's all going to roll over again, and we'll see the big sell-off. I expect bond yields to continue to rally as they start pricing in the probability that the Fed have to pivot and the economy's gone too far and inflation is broken. I then would love to see oil break. I'm not 100% sure of that one, but I think it's likely. It's mapping very, very well oil in 2001, and oil in 2001, almost identical price action. You can overlay the charts, and it collapsed 45%, much like it did in 2018. So I think that's probably coming. That changes the narrative, and eventually the Fed, sometime in the summer, are going to go, and probably after the June meeting, they're probably going to go, okay, we'll monitor the situation, and maybe we won't tighten the balance sheet yet. That signal is the signal for risk assets, I believe. And I think we'll see growth end of tech, which has been utterly destroyed and is down 70% plus, and crypto, and probably gold actually, start to outperform along with bonds. And those should be the phoenix that rise from the ashes, and some of these other more cyclical plays will do less well. Those are the things that have been outperforming over the last 18 months. The big question is, what is it going forwards? Is this going to be a longer recession, in which case everything rallies and then comes back down again, the Fed have to do a lot more? Is that what brings the Fed balance sheet in? Is the markets roll over and the economy looks terrible? I'm not sure. My base case scenario is a V-shaped recovery from a absolute cliff edge. But it could be something more drawn out, in which case we've got a much nastier equity bear market to come. But we'll wait and see. So it's a pretty grim prognosis, but I think this is the opportunity I've been looking for. I've been buying technology stocks gradually on a dollar cost average basis over the last couple of months. I will probably go out another month, and that will give me hopefully this whole low period if I get this right. The weekly DMARC indicators give us between 2 and 4 weeks for this low to come in. Crypto is identical right now. We've got the bad signal of we need the dailies to get where we're going, and that's probably another week or 10 days away of this kind of price action that we've been seeing, which is pretty ugly. And the weekly indicators are somewhere between 2 weeks and 5 weeks away before we get the final capitulation lows. It was that DMARC setup that got me out of being short, or out of my shorts, and out of many trades in the pandemic as well. And I take them very seriously because they usually lead to very good signals. So I think it is the economy. I think every time the ISM starts hitting 50, they realize, okay, the economy's going down. Because what does ISM 50 mean? It also means unemployment goes up. ISM 50 is almost certainty every time ever historically that inflation comes down. So it's going to give you that. It's going to give you the rate of inflation coming down. They know it's going to come down because of that. And I think that they're going to find that, sorry, I'm just trying to, I've gone out of focus for some reason. There we go. The rate of inflation comes down, the economy goes down, and unemployment goes up. Now, if you listen carefully to what's going on with the tech companies, they're laying off people. Amazon said, their words, they were wildly overstaffed for demand. Everybody's built up massive inventory, so we've got inventory liquidation to come, which drives down ISM dramatically and GDP growth, and tech companies are going to be laying off staff. Every single VC has kind of said to their investment class, hey, listen, you need to reduce your costs. And I think that message is not lost. So that's what's to come, and they'll see it very fast if I'm right and ISM comes off really quick. And that's the balance they're trying to walk. As you said, break-evens, 5-year break-evens are off 100 basis points. So they're down at 3%, at 2.8%. Now, it's not very long. If I'm right in what's happening, those 2-year break-evens are going to be back in the kind of 2.5-2% range, which is where the Fed wants it. So what they need to see is the headline rate of inflation come down, which is going to start turning down, and then they'll be okay. Now, don't forget, they started cutting in 2001 and 2008 and 1974 and 1984 before inflation peaked. So it is possible. Maybe it's where we are in the election cycle means they won't, but they're going to lose an election if they destroy everything. Because if your purchasing power has been destroyed by the inflation and then you're out of a job, I mean, you're double fucked. And that is not good for winning an election, or midterms anyway.